The Two Futures, Photograph 1. Let me show you two photographs of the same person. The first photograph is taken 20 years from now. This person is sitting at a kitchen table, looking at a number on a screen. That number is large enough that they will never again lie awake at night, wondering how to cover an emergency, a medical bill, or a rent increase. They didn't inherit anything. They didn't start a company. They didn't win a lottery. The second photograph is also taken 20 years from now. Same person, same job, same salary, same amount of money set aside every single month. But this version is staring at a very different number one that has lost nearly a third of its value. This version checked their account every day. This version read the news, studied the charts, reacted quickly, and worked hard at growing their money. And that work is exactly what destroyed it. The financial world's dirty secret. Here S, the part that should make you uncomfortable. The wealthy version and the broke version made the same income, saved the same amount, and lived through the same economy. The only difference between them was a handful of decisions. Decisions that felt completely reasonable in the moment. Decisions that you, watching this right now, would probably make too. Because the financial world has a dirty secret. It runs on a set of rules that operate almost exactly backwards from everything you've been taught about life. Your whole life, you've been told that effort creates results. Work harder, earn more. Pay attention. Do better. The instinct trap. React fast. Stay ahead. And in almost every other arena, your career, your fitness, your relationships, that's true. But inside the stock market, that instinct is a trap. A trap so well designed that the harder you struggle against it, the deeper it pulls you in. And the people who built the system, they profit every single time you take the bait, every panicked sell, every excited buy, every small fee you never bothered to read about. The confusion isn't an accident. The intimidating vocabulary isn't an accident. It is a business model, and you are the product. Lazy versus hardworking, the paradox. So how did the lazy version of you end up rich, while the hardworking version ended up sweating over next month's rent? What exactly did one of them see that the other one didn't? To answer that, we need to start at the very beginning with a question that sounds simple, but that most people, even people who've been investing for years, get completely wrong when you buy a stock. Where does your money actually go? Because I promise you, it's not going where you think it's going. Here, S, what nobody tells you on day one. Most beginners assume that when they buy a stock, their money flows directly into the company that they're refunding the factories, the salaries, the next big product. It feels like you reinvesting in the business, but unless you're rebuying shares at the very moment a company first goes public, that's not what's happening at all. The company never sees your money. You rebuying your shares from another ordinary person, someone on the other side of the screen who, for reasons you will never know, decided that today was the day to sell. Sit with that for a second. Every single trade has two sides. The global arena of bets. When you buy, someone else is selling. When you reconvinced the price is about to go up, the person selling to you is often convinced it's about to go down. One of you is wrong. The stock market isn't a store where you purchase products. It's a global arena where millions of strangers place bets against each other, every second of every day, on what a business will be worth tomorrow. And what exactly are you buying in that arena? A stock is a piece of ownership, a legal claim on a tiny slice of a real company. The buildings, the machines, the patents, the brand, the cash in the vault. When people say equity, that's all it means. You own a fraction of that pile. A bond is different, that S just a loan. You lend a company money, they pay you interest. And if things go wrong, lenders get paid back before owners do. Owners stand last in line. That's why stocks can make you far more money than bonds, and why they can also take far more away. Now, here's where the trap starts to take shape. The moment you open a brokerage account, the industry rolls out a red carpet of tools for you. Tools that feel like power. Buy instantly at whatever the current price is, except in a fast-moving market. Whatever the current price is can be meaningfully worse than the price you saw 2 seconds ago, and that gap comes straight out of your pocket. Then comes the truly generous offer. They'll lend you money to invest with, borrowed money on top of your own. If the stock goes up, you win double. What they mention more quietly is what happens when it goes down. The broker doesn't wait patiently for a recovery. The margin call nightmare. Past a certain point, they force you to sell everything at the worst possible moment to pay back the loan. You can end up losing more money than you ever put in. Not zero. Below zero. Why would they offer you all this? Ask yourself who collects a fee every time you make a move. And while you re-navigating all of that, there are people in this arena who aren't just betting against you, they re-rigging the table. Picture a small group of wealthy players quietly buying up a cheap, obscure stock that almost nobody trades. Then, suddenly, the stock is everywhere. Social media posts, hype videos, whispers of a guaranteed opportunity that's about to explode. Ordinary people pile in. The price rockets upward, and it feels like the rumors were right. But the price isn't rising because the company is succeeding. It's rising because thousands of small buyers are cramming through a tiny door. And at the very top, the original group sells everything, dumping their shares into the flood of excitement they manufactured. The inevitable collapse. The price collapses in hours. The insiders walk away rich. Everyone else is left holding something worth almost nothing. Here's the uncomfortable pattern hiding underneath all of this. Every one of these traps has the same trigger. Not stupidity, not bad luck, emotion. The fear of missing out gets you into the scheme. The thrill of leverage gets you into debt. The rush of fast trading empties your account one small fee at a time. Which raises a question if emotion is the trigger. What happens when the entire market, every investor on earth, feels the same emotion at the same time? Because that day always comes. The economy sours, prices everywhere start climbing. Central banks slam the brakes by raising interest rates. Businesses slow down, and the market begins to fall. 10%, 15%, the biology of panic, 20%, your account, years of discipline. Years of sacrifice starts evaporating in real time. And every cell in your body starts screaming a single command. Get out, now. And what you do in the next 60 seconds will decide which photograph becomes your future. So let's talk about those 60 seconds. The market is crashing, not dipping, crashing. You open your account and the number staring back at you is 20. Maybe 30% smaller than it was a few weeks ago. If you had 100,000 saved, 30,000 of it is simply gone. That S a new car, that S years of disciplined saving, vanished not because you did anything wrong, but because the entire world decided to panic at the same time. And the news makes it worse. Every headline says, "This time is different. This crash is the big one." Economists on television are using words like unprecedented and collapse. Your coworkers are selling. Your family is asking if your money is safe. And a voice in your head, a calm, reasonable, protective voice says, just sell. Get what S left out. You can always buy back in when things settle down. That voice sounds like wisdom. It is the single most expensive sound you will ever hear. Paper loss versus real loss, because here's what selling in a crash actually does. Until the moment you click sell, your loss is only on paper. The number is down, but you still own the same slice of the same companies. And history shows those companies recover. The moment you sell, the paper loss becomes real, permanent. You V-locked it in. And now you re-standing on the sidelines, holding cash, waiting for that settled down moment to buy back in. But here's the catch: that moment never announces itself. Markets don't recover politely, in slow motion, giving you time to climb back aboard. They recover violently, in sudden bursts, often on days when the news is still terrible and everyone is still terrified. Some of the market's biggest single-day gains in history happened right in the middle of its worst crashes. Miss just a handful of those days because you were sitting in cash, waiting for permission to feel safe, and you can wipe out a decade of returns. Think about what happened in the spring of 2020. A global pandemic shut down the world, and markets fell off a cliff in a matter of weeks. Millions of people did the smart thing. They sold. They protected what was left, and then, while they were still catching their breath, the market turned around and staged one of the fastest recoveries ever recorded. The people who sold at the bottom didn't just lose money on the way down, They missed the entire ride back up. They were punished twice for one decision. And when they finally worked up the nerve to buy back in, prices were higher than where they de-sold. They sold low and bought high, the exact opposite of the only rule everyone knows. Now, maybe you rethinking, the answer is obvious, just be smarter about it. The unwinnable game, sell before the crash, buy at the exact bottom, time it right. Here's what nobody tells you: that game is unwinnable. Not hard unwinnable. Nobody rings a bell at the top, and nobody rings a bell at the bottom. The largest investment firms on earth, armed with armies of analysts and supercomputers, fail at this constantly. What makes an ordinary person with a phone app think they'll succeed? Even the cautious version of this, keeping your money in cash, waiting patiently for the next crash so you can buy the dip, quietly fails. Because while you wait, the market often climbs for years, and the dip you finally get is higher than the price you refused to pay in the first place. Waiting has a cost. It's just invisible. So look at where we've arrived. Trading fast loses. Borrowing to invest loses. Following hype loses. Selling in a panic loses. And even the careful strategy waiting on the sidelines for the perfect moment loses. Every exit is sealed. Every clever move fails. The ultimate conclusion: every instinct, you have the instinct to act, to react, to protect. To outsmart leads to the same place, less money, which forces us to a conclusion so strange it sounds like a joke. If every form of doing something loses, what happens to the person who does nothing at all? Not nothing out of ignorance, not nothing out of fear. Nothing as a strategy, deliberate, structured, ice cold, nothing. Because that person exists, the wealth transfer machine, and what the market quietly does to their money while everyone else is buying, selling, panicking, and predicting, is the part of this story the financial industry would prefer you never fully understand. Here's the twist that the entire story has been building toward: the stock market is not a casino, and it is not a battlefield. It is a wealth transfer machine, quietly, mechanically, year after year. It moves money out of the pockets of the people who do the most, and deposits it into the accounts of the people who do the least. Effort in, wealth out. It is the only arena in modern life where the harder you row, the faster you sink, and the industry that surrounds it has every incentive to keep you rowing. Think about who gets paid when you act. Every trade you make, someone collects a fee every time you sell at a profit. The tax office takes a larger bite than if you simply waited. And every year, professional fund managers charge you a percentage of your money for the privilege of trying and usually failing to beat the market. That last one deserves a closer look because it's the quietest theft of all. Say a fund charges 1.5% a year in fees. 1.5%, it sounds like nothing like a rounding error. The tip you leave without thinking, but that fee doesn't just take a slice of your money, devouring your future. It takes a slice of your money as future children. Every dollar removed today is a dollar that can no longer grow, and its growth can no longer grow. For the next 30 years, run that math over an investing lifetime, and that innocent little fee can quietly devour hundreds of thousands of dollars, enough to buy a house transferred from your retirement to someone else's. One invisible sliver at a time. You'll never see it leave. There's no receipt. There's just a smaller number at the end of your life than there should have been. So what does the winning version of you actually do? Two things. It's time. And time is the one thing every ordinary person has, and almost nobody uses. That is the whole secret. That is what separates the two photographs. Not a hot stock tip. Not insider access. Not genius. One version of you automated a boring monthly purchase and then spent 20 years ignoring the account. The other version of you paid attention, and paying attention cost them everything. But before you close this video feeling like you've found the answer, I need to be honest with you about something. Knowing this changes almost nothing, because the strategy isn't hard to understand. A child could follow it. Buy everything, automatically, forever, and look away. The real challenge, the reason so few people end up wealthy, isn't a knowledge gap. It's that this strategy asks you to do something far more difficult than picking stocks. It asks you to override your own survival instincts. On command. On the worst financial day of your life, it's easy to nod along right now, while the sun is out and your account is calm. But the real test doesn't happen now. It happens years from today. On some gray morning, you can tape predict. When you wake up to headlines about a collapse, when your account has lost a third of its value overnight, when the people you love are asking whether the money is safe, and when every voice around you and inside you is saying that this time really is different. On that morning, the strategy requires you to look at the wreckage, feel the full weight of the fear, and let the automatic purchase go through anyway. Buy calmly. On the exact day, your instincts are begging you to run. Millions of people knew everything you now know. They read the books, they watch the videos, they could recite the rules perfectly, and when their morning came, they sold anyway because in that moment, doing nothing didn't feel like a strategy. It felt like standing still inside a burning building. So the question that decides your future was never really about the market at all. The market will do what it has always done: crash, terrify, recover, and grow. The ultimate variable, you, the only unknown variable in this entire story, the only thing that separates one photograph from the other, is standing in your mirror. You now know exactly how the trap is built. You know the machine rewards stillness and punishes motion. You know the crash is not an if, but a when. So be honest with yourself just this once when that morning finally arrives and 30% of everything you've built disappears while you still holding your coffee. Could you really do nothing?